formal talks are yet to take place. OPEC Plus are not leading one way or the other, but it's clear to a lot of market participants that that with crude prices coming off, OPEC had to come out with this headline indicating that, okay, don't forget about us, we still have the existing cuts going on and we're going to extend that to keep up the oil prices.
Yep, makes sense. You need to create a bit of momentum in that official headline, which will come out on June 1st. Hello everyone, welcome to another market episode of the World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group. Today I'm joined by the usual crowd, Vincent, James and Martha. So we keep grinding along in oil markets after a washout concentrated on the downside. OPEC have taken back the attention in markets as the June meeting looms, with spurious headlines leaked into the media, hinting at a continuation of the existing cuts, whilst we have had a relatively calm period in the macro markets to allow us to really focus on the ongoings of the intricacies of oil. Just before we start, just wanted to point out that we have made freely available our monthly report for May. This goes into all our positioning data, our outlooks, forecasts, and beyond. It has our trading views by desk. And if you would like to access that, the link is available in the description. I hope you enjoy the podcast. Thanks. So on that note, let's get straight into it. Martha, do you want to start us off?
Yeah, of course. I think, you said it in a word, washout. It's been an absolute washout. We're down below $82 a barrel now, which we've not seen in since March, I think. So we're definitely on the lows of this kind of cycle that we've been going through. The main talking points in the market are the weak economic data, which I'm sure James will talk about. Refinery margins are poorer again, remaining poor, with a weak underlying physical in many of the markets, especially the dated market is becoming a lot weaker. And US-wise stocks, we've seen builds, which has undermined confidence further in the US markets. We saw a build of over 7 million barrels in the last release from the EIA, compared to the median estimate of a draw of 2.5 million barrels, which is a pretty significant difference. And we saw builds in gasoline as well. And the API release, however much you trust that we've just had, has shown another build in crude and a build in Cushing as well. In terms of the physical market, I'll probably talk about this a little later, but we have been seeing the physical staying really well supported, and we've been always going back to saying, oh, the future's doing this, but with the physical is still at a decent level. But we've kind of seen this get washed out too, as we saw this trade house kind of propping up the physical market with constant bidding, but a really long bull play for maybe months. It's been ages, but they basically flipped to really aggressive selling and physical cargoes into the beginning of the month.
You're talking about the North Sea?
Yeah,
I think again, like I was saying at the beginning, it's been a very macro-driven market, I would argue, for and macro I would include the kind of geopolitical tensions. And as that eases away, and we talked about this last week about headlines losing people's attention after a while. And so you're looking for the next narrative. And I think given that we've had such a sell-off in the outright price and, as you say, physical markets, you got to look at a new narrative. And yeah, so we say OPEC, we could talk a bit about that. But actually what you're saying about the US, another key headline yesterday was the issuing of I think a 3.3 million barrel tender, whatever it was, from the SPR. And so that makes a lot of sense, right? They're on the back foot. They need to fill that to have, a good strategic position, or reduce the weak position they've got against OPEC in terms of vulnerability of supply. So I think it makes sense that as we're on the way down, as things are weak, as things are building, you just take that all into the SPR as much as you can. So I think that makes a hell of a lot of sense. Also, as you're saying, we had this big sell-off, and let's include, Brent flat price, diesel cracks into that, very macro related contracts in oil. And then you've got gas oil spreads in contango, and then you've got the weakness in the physical following the macro move, which is, to a lot of people quite odd. But that's the nature of sentiment. Sentiment isn't just the paper derivative transactions, right? Sentiment can be in the general market. It can even be in the physical market. We know this, right? Even in localized in the UK, when people thought there was a shortage of gasoline, which it turns out there wasn't, everyone in the whole country was queuing up to buy gasoline, and it artificially created a shortage. So in the physical, if you're looking at it, from the physical trader's perspective, they see a big sell-off. They probably got hurt if they were long, speculatively long. And then we have such an aggressive sell-off that you move into contango. So then people say, yes, stocks are really high. So yeah, because they're in contango incentivized storage. So it comes after the fact in a way. And it's again, another like element of us saying derivatives are it's flipped, right? Derivatives move the physical, not the other way around. So, you know, contango is a great testing point for the market. Are we going to continuously store, or does the open market actually need the oil, and does it just come right back out? And that's, I guess, the will be the test. And I think we've said a few times, like, you know, the risk, the market's belief in the movement upwards in oil contracts was always concentrated in the summer, which is, you know, about a month away from starting to get active, I would say. So that again is the next test. But James, do you want to go into the macro, just because, you know, I say it's kind of calmed down, but I literally mean fleetingly. But there's still quite a lot going on, right?
Yeah, it's a pretty big week. Last week, we had the Fed out, first of all. And data-wise, we now have, from an inflation perspective, don't forget the Fed has a dual mandate, low inflation and full employment. The inflation perspective, the data's disappointing the Fed. CPI, PPI, employment cost index and unit labour costs have all come in above expectations, are trending higher. The flip side, so at the Fed meeting, Jeremy Powell made 3 key comments. Firstly, he said, I think it's unlikely the next rate move will be a hike. He then said, I do think that policy is restrictive. And important one at the end, he said, unexpected weakening in the labour market could warrant a cut. Then on Friday, we had weak payroll data. We had weak JOLTS data during the week, which is job openings is falling. Quits index is falling. Less people are quitting jobs, which are both weak from an employment perspective. But the payrolls was the first week payroll for months. Only 175,000 jobs created, far less than expected. Crucially, the unemployment rate's ticking up now, 3.9%. Another point with ISM data, the ISM manufacturing and ISM service data, employment's been contracting in both of those for 3 months consecutively. The only time, or the last 2 times that happened, was 2020 and 2008. So the Fed have said basically they don't want to hike again, and we're watching employment. Employment's now coming in.
But the only thing stopping them is inflation.
Yep.
And inflation, you could argue, has been, I know it's lagged, but with the recent sell-off we're seeing in these prices, in the oil prices, gasoline in particular in the US and diesel being economic indicators, if they've come off, you know, a decent chunk, that should feed right into inflation figures in a couple of months' time. So you would like to think that will happen as well. So it could go back to the sentiment believing in a cut again, quite believably,
Exactly.
right?
Yeah, we have inflation next week.
Right, okay.
Inflation data. On that, I have 3 charts.
Sorry, inflation data for which month?
For last month.
Yeah, this is always it, isn't it? So we think right now we're easing inflation, but you won't know for another month. And they're always making decisions on the last month, which is kind of interesting. Sorry, go on.
Yep. So 3 charts. One of them, the first chart shows the economic surprise index, which is falling sharply. Basically, the economic data in the US, really from the 15th of the month, is coming down.
Sorry, economic surprise index.
Yeah. So it's how the economic data actually comes out against the economists' expectations.
Interesting. Yeah.
So it's coming out much worse than expected. Really sharp turn on the 15th of the month. And you can see how highly correlated that is, firstly with the dollar index and secondly with the US 10-year yield, which would suggest yields lower and dollar lower. And especially now, really, the hike's been taken off the board by the Fed. So the market, with the employment data as well, yields have suddenly started to turn lower. The market's starting to look at when the Fed will start cutting. The OAS is pricing from 34 basis points of cuts this year. It's now pricing 44. And then I bring in 2 other charts, basically looking at the bigger picture, looking at the correlation of yields or the economy and Brent. So for the economic sentiment, I've taken the 2-year yield. That's the easiest barometer. And even if you go back further, here this is back to 2016, you can see there's quite a strong correlation, except for the time when the Fed clearly kept rates too low for too long. And then the 3rd chart basically looks at the last 18 months. And what I like about this correlation is when the market was talking about October, November, December, Brent geopolitical crisis should have Brent higher. Brent was coming lower when the market was pricing in a recession and a hard landing and 160 basis points of cuts. So basically highlighting, although we look at so many factors can affect the Brent price, basically the underlying US economy and the sentiment towards that has a big impact as well.
I would say it's lead and lags, like I'm saying, with the current prevailing narrative. And for sure, the macro kind of US narrative has been critical for financial flows in oil. I guess my point is, now that you've washed out the geopolitical side and you've had, I guess a reduction of that positioning in general in the oil market, I think you can find a new one now. So will oil markets react going forward? I mean, any excuse to be bullish. So if the Fed does cut, it will help people run into or go into oil again and be supportive. But I think you see my point is in, like, even the investors, even though they'll say I'm basing it on macro, they'll still want to, this is kind of becoming a little bit old news now, wouldn't you say? You've tired narrative going back and forth. It feels like it's probably as bearish as it could be right now in terms of how you would trade inflation based on what the Fed's doing. So
but
now
I would say the flip side is the market's starting to price cuts again.
That's what I
and
mean.
starting to go recession.
Yeah.
So that could, the
but
US
you wouldn't
is,
want to get excited about it again, only to get burnt again. But you see what I mean? So it's like, how are you going to justify your risk parity investment unless you're starting to look for another reason, a more compelling reason?
also it then becomes just data watching, which is what the Fed are clearly having to do now.
Sure. Okay. And the third graph?
The third graph looks at the last 18 months, much shorter term perspective. And you can just see how strong the correlation is. The key point here, as I said, when Israel, Hamas tension started, October, November, December, people wanted to be long.
Sorry, so this is overlaying what exactly?
Brent with a 2-year yield.
2-year
US
yield.
2-year.
Okay.
So the 2-year gives you a tighter barometer of the economy, how that's performing. October, November, December, Brent fell while people were expecting it to go up on geopolitical tensions.
Yeah, it's a fair point. Okay.
But the market was pricing a recession. So the US is over 25% of the global GDP. So that's why, and again, going back to the first chart here, if economic sentiment is turning lower and the market's starting to price cuts, yields coming lower, then that would be a drag on Brent price.
Yeah, so for me, it's like, again, you got to know what the rest of the market is looking at, which is why positioning data is so important. But then you got to know, you got to keep up to date with the narrative. So a lot of the time, and I've definitely been guilty about it in the past as well, you can be stubborn, especially as an oil trader, and say, I don't care what that area is doing. I wholeheartedly believe in, say, fundamentals. I wholeheartedly believe in what's happening in the underlying swap market as an indicator of what's going to happen on flat price. But it's the power of, like, markets move to positioning, changes in positioning, and whoever's got the biggest weight of positioning that moves at any one time is gonna win. So you have to know. So to look at a chart so tightly correlated with interest yields, it's kind of almost annoying, because it's like that was all you needed to essentially predict the markets to some degree. And so you can have all these talks about Gaza and whatever else, but realistically, if the power of the money that's moving in and out of oil is just focused on interest rates, and that's all it's going to be for a time. And you would like to think that the signal for that not being the case anymore is a widening of this correlation. Then you can start to look for the next kind of major mover of markets, if that makes sense. But I guess the problem with correlations is they're always retrospective. So yeah, it's still very, very, very interesting. Okay, but on the underlying market side of front, again, Vincent, let's talk about refinery margins, because they were the number one reason why we were bullish. And I think a lot of people were bullish. A lot of people have systematic models that say, if a number of things do X, buy. And one of them, which is probably 80% of a lot of people's models, is refinery margins. If they're strong, people buy crude oil. So that weakening, whatever the reason, has caused shock waves to the prevailing sentiment. So how are we looking right now, and what's the general picture?
Yeah, definitely. So refinery margins were the major reason for bullish Brent over the past few months, and now it's the major reason that the market sentiment has flipped, as we have seen with physical differentials in data Brent falling down, as well as in Brent spreads, because this was the number one justification for being bullish, and the reasoning isn't there anymore. Interestingly, week on week, we did see a small increase in margins, but that's due to weakness in the crude flat price. And it seems that it's on the basis of weaker crudes competing against weaker products. So that includes distillates, which has already washed out recently. But last week, gasoline was the major washout, because there was major selling in US gasoline RBOB futures on screen, which led to weakness in Europe and Asia gasoline as well, because it's mainly the price action in Europe is driven by US liquidity, and that was also exacerbated by the build in EIA stats indicating gasoline build. That's quite a bearish factor. We've seen from CFTC data that money managers have added shorts in RBOB US gasoline for 6 of the last 7 weeks. The market is getting shorter and shorter. People are adding more short positions. Perhaps, price action was artificially quite high as investors or traders were preparing for the summer demand story. Perhaps because the macro sentiment just isn't there anymore. That's why the flows are dominating. But another narrative is that now there's less threat to the global refinery capacity after Ukraine has stopped attacking Russian refineries following US pressure. Of course, Biden administration do not want oil prices to rise too much. Another headline came out yesterday was Alexander Novak, Russia's deputy prime minister, said that Russia will consider lifting its gasoline export ban for 6 months. So that affects the European market. This has also reduced naphtha exports recently because of the ban, because of increased gasoline blending demand within domestic Russia. So now it means that perhaps Russia will be looking to export more of its naphtha, which is a more bearish factor. So all of these are compounding towards a very weak refined products market, which in turn is leading to a weaker crude market in terms of demand.
Yeah, I mean, this is all great stuff. I think, Q3 EBOB, summer EBOB, summer RBOBs, basically summer gasoline. We're saying that like the open interest has fallen quite a bit. The people have been getting shorter because they were very long, so selling, and I think you're getting some pretty serious washouts there. So people giving up on this summer trade quite early, which is what it is. But I think it's looking at where things are at now. So it's interesting you say that US exporting more naphtha, because the propane market as well has been actually it was something. Martha, you wanted to be short ARBs on a trade idea about a month ago, 3 weeks ago.
Oh, the propane ARB. Yeah, we did
and that has absolutely plummeted, and it got through a key bit, was about 200 per metric ton on the prompt, and that's now like 250. And when that happens, that's the arbitrage is wide open to send propane east, and of course naphtha is going to be quite tightly linked, competing for the petchem cracker space. So that is significant. And when you say that exports are generally, things are getting so weak that you can export a lot, freight then tends to move up. So we've got auction prices for basically getting slots to put ships through the Panama Canal. They've gone up considerably. I think they hit the psychological level $1 million, which is historically quite high. Then up to 1.7 million. So I think that's showing signs of tightness around that area. It could be localized, could be a short-term thing. It's very early in the year for this to happen. We usually tend to see it like we did at the end of last year. But either way you look at it, if you're maxing exports and it's costing you a lot to move the ships, it doesn't matter how wide the arbitrage is on paper. Freight is going to really rally and inhibit any kind of exports because everyone's just maxing it out. So what does that mean? Well, when you get freight strengthening quite a bit, you get localized strength in areas that can't receive the oil. So I think an example would be propane Asia contracts that have been so weak, and for the first half of the year, a leading China story, Chinese economy doing badly. It's completely flipped, and we've talked about this plenty of times, but you're seeing aggressively bullish price action in Asia propane, which would make sense if you're maxing exports and there's the demand there, and then now you're getting freight being inhibitively high. So I think if naphtha follows suit, it might seem bearish, but actually if they're a net importer in Asia of naphtha and you're already maxing out the exports and freight's getting higher and higher, if anything, it's quite bullish, with so much moving around. So with this happening as we get to summer, I think the market's at risk of being now too short or too balanced, given all the risks that we had at the beginning of the year were based on the year before repeating itself, and that's refinery fires, refinery outages, and that's demand. And to suddenly wash all those away seems premature, and then now we're actually getting signals of demand. So China back in focus, which is we've put in our oil market report, which will be available to everyone for free. We'll talk about that at the end. But that's pretty key, right? China coming back in, they've been the driver of oil demand increases in people's models for years and years. Whenever anyone predicts an increase year on year, it's usually at least half because of China. So for them to be back in the game, at least from the evidence of what the price action, that's a hugely significant thing. So if everyone's going to get kind of at least out of their longs, but possibly even getting shorts, I'm quite surprised to hear RBOB shorts in money managers. Like, that's quite a ballsy move from hedge funds to be short gasoline into the summer when things aren't looking that bearish. It's just, ultimately a bit of a washout. So yeah, this could make the great conditions for now the trade that everyone was expecting. It's just all about positioning and timing. So headlines then, ones to watch. We actually haven't got it in the notes, but one that's probably quite key is EIA, right? The EIA came out with they're slashing to demand forecasts and the growth of oil production, which again just feels a little bit like they're just reacting to lagged data. Again, we're missing the point that summer is where everyone's expecting this demand increase and the supply cuts from OPEC to really bite. So that was interesting, but I think it's kind of like a bearish headline. That's the reason for some of the weak price action in outright prices this morning. But I think you're getting to that period where a bearish headline comes out and the market isn't really reacting that strongly because it's already reacted very strongly to weak headlines. So I think we've got to talk about OPEC, right? And that's probably the main headline that's going to start driving things, right, Vincent? Do you want to?
Certainly, yeah. OPEC Plus could extend oil cuts. Formal talks yet to start, sources say. So it's a classic. Perhaps you could say a deliberate leakage of information. How sources talk to journalists before prior to OPEC
see
meetings.
How the market takes it.
Yeah. The timing was quite interesting because I believe this came out. I think either last Tuesday or Wednesday as crude flat price came down by a few dollars, and in the afternoon the article got released talking about could extend the oil cuts. So from this article there were 3 sources from OPEC. Basically there a few points. So one, surprise jump in demand for OPEC. So you would need to see a big surprise for OPEC Plus to make any changes. Another one saying cuts could be extended to year end. The other one was more, let's say, conciliatory, saying formal talks are yet to take place. OPEC Plus are not leading one way or the other, but it's clear to a lot of market participants that with crude prices coming off, OPEC had to come out with this headline indicating that, okay, don't forget about us. We still have the existing cuts going on, and we're going to extend that to keep up the oil prices.
Yep, makes sense. And you need to create a bit of momentum in that official headline, which will come out June 1st. And again, it correlates with summer, so it doesn't look like the market's thinking about this at all. But I mean, if you guys agree, it's like that will be a critical point where if it's going to shift to the upside, that was when the momentum will start building again, the positioning. Alexander Novak, his quote. Did you say that earlier, Martha?
No, but I've got it here.
Yeah.
Everything is being analysed right now. You don't need to predict anything. Just need to see how the market feels. And then later he says that the voluntary cuts can be adjusted to boost supply if necessary. Basically threatening to kind of extend the voluntary cuts beyond Q2, but also kind of threatening to loosen them. I know Vincent said earlier that the market was already bearish, but I think the reaction to these leaks was actually quite bearish as well. Further on, they've been kind of reminding the market that they're there in their nice cryptic way they always do, but also it's threatening supply. When the market is reacting bearishly to a threatened supply, it shows that the market doesn't think that the supply is the problem. It shows that the underlying demand might be what the market is looking for signs of hope for, which I think is quite accurate in how we've seen these jumps up with positive economic news we've had when there has been any. And I think that this may just be, I know that we've used in reports before, we've explained that OPEC is just kind of they have the one card and they play it again, and sometimes it can kind of be jamming a square plug in a round hole, and it's not quite what the market needs.
Yeah, and saying, see how the market feels is another way of saying we got full discretion. If it looks like the market just won't rally, then we'll force it to rally, and that's always been the case. So but I guess we have always said the first half of the year, we're talking about refinery maintenance and all that, and refinery outages being a leading reason to be long products. But we were saying if everyone's quite clear in that. When I say everyone, like leading analysts and therefore their traders and traders at majors, when we say we're bullish, we think it's going to come into fruition Q3. That was definitely the consensus. Now the whole curve gets dragged up because that's just the way curves work. You buy one thing, you concentrate. It's very hard for the market not to be dragged up at the prompt, because if it doesn't, then you've got a contango, and then people are going to store and kind of borrow from the forward demand into the prompt. It's just the way it works. So I think that exactly as you say, Martha, like it's a demand story that I think wasn't there, but because it was too early for the market to be priced there in the prompt. And that kind of logically makes sense once you start bringing in physical premiums. And can the market take the levels that the market's being priced because of Q3 buying? Well, the answer is clearly no. So there was risk to Q3 kind of crack rolls, or Q2 versus Q3 products that, we were saying is the risk, can it sustain itself? And it looked like it was getting pretty close, to be honest, at one point, that it would sustain itself. It's only really in the last couple of weeks. And the leading like scenario from there is, ironically, from like macro headlines that's kind of fed through. So yeah, super interesting on there. So as we come in, I mean, you guys are talking about North Sea. I think that's worth mentioning as well. North Sea has been incredibly volatile in the actual prompt contract. So this is where the physical is actually changing hands. And so when we talk about physical moving prices, these are the contracts, the dated Brent contracts in the very prompt, where you can actually say that's largely true. However, if you look at it versus the Brent time spreads, which are more deferred 2 months forward and beyond, they've stayed heavily backwardated like pretty much all year. And it was just whether or not we go further than $1 backwardated expiry or not. And even now we have this big washout. You're still 40 cents plus on the prompt spreads, which is still a backwardated healthy market. It's only in the very prompt that physical differentials are going to like +2 down to -1 up to +50 down to -20, and it's nuts. But this is because the incremental barrel, or the marginal barrel, is what sets the price. In other words, everyone's priced expecting the physical to change hands at, let's say, +50 to the benchmark. And then you only need one cargo to come in and not be able to be bought because people's refinery systems are full and oil traders can't find a buyer. That one cargo can bring the global physical differential benchmark all the way down. And that's what's happened. And you keep getting this. So people getting overexcited, getting too exaggerated with their buying. One cargo or a few cargoes bring it all the way back down. And it just is a cycle repeating. But I think you have to say it's still, quotation marks, strong on a kind of number basis. So I don't think we kind of change our view there.
We got one or two more interesting ones. So BP reported their Q1 earnings recently, and reported that their profits slumped to $2.7 billion amid falling oil prices, but has announced a continued $1.75 billion share buyback, which has been the case over the past quarter. So this was a below consensus forecasts from analyst of $2.9 billion. Key reasons that analysts have mentioned include the impact of the Whiting Refinery outage from Indiana, US earlier this year, as well as weaker refinery margins that has hit earnings. At the same time, underlying replacement cost profit is down $1.6 billion in the first quarter, which is down from $8.7 billion year on year. In simple English terms, it is a financial metric, the underlying replacement cost profit, that adjusts for one-time items and inventory cost fluctuations to more accurately reflect the company's ongoing operational performance. So its share prices have fell since the announcements.
Yeah, I think what they're not saying is you can mention oil, but really power and gas was such a big driver in 2022 and even 2023 to some extent of like bumper profits in trading. So it's just not been a good year for power and gas. I would argue that's probably a big chunk of it. But yeah, of course, it makes sense. The other physical things, Whiting Refinery, etc. And then they're always on their share buyback mission, which I think has been going on for years. But that's because they fundamentally think their stock price is undervalued, which has been massively underperforming against the rest of the kind of big oil companies, Exxon and the like. And of course, Bernard Looney left, other reasons allegedly, but of course, it wouldn't have helped that his the stock price performance has been so poor. So when that's the situation, you can give out dividends, or you can you can share buyback, and if the share buyback is at a good level, then why wouldn't you do it, right? So it makes sense that that's what they're doing, and it's an interesting thing to bring up. We should do that more. The kind of public announcements from oil companies, or especially oil trading companies. That's a specialty. And that's it? Or
there's another one which is more related to our niche market. So that's a NAFTA headline. Russian oil products stranded at sea as Korea cracks down. So we're seeing over the past few weeks, more than 2 million barrels of Russian naphtha have been held in 10 tankers for over a week in the sea as petrochemical makers in South Korea, traditionally major buyers of this of the Russian product, which is a major feedstock for the petchem industry and plastics making. They're shunning direct imports from Russia. So that includes buying from them directly or cargoes with unclear origin. This follows the crackdown from South Korean authorities as they've began investigating these origins since March. So it's an interesting shift since the Russian invasion of Ukraine, because in 2021, South Korea had imported 26% from Russia. They used to get most of their naphtha from Russia, but since then that share has dropped to just 4% by 2023, and since then imports from the Middle East, including from Kuwait and Oman, have risen. So Russian flows to South Korea have decreased, and with authorities looking to crack down on this, it seems that that the shares will likely fall even more. Petchem, so companies are worried about threats of sanctions, especially if governments crack down on this sort of stuff.
Yeah, no, good. That's an interesting variable, because Russia exports changing, and as I said, Ukrainian hitting the refineries, it has had an impact on the market. So you can't just ignore Russia just because the West have said they're sanctioning it. It's still a really key staple flow from both products and crude. So yeah, fair point. What's the trade idea this week?
The trade idea for this week is to sell the European naphtha crack in the prompt June contract. We've seen loads of pressure this week, and we expect this to continue heading south, especially if we see any crude strength, once levels kind of bottom. We've seen really strong selling in the spreads. I think coming into May, we saw kind of the level built up to this artificial strength that wasn't quite justified. I know we mentioned in the podcast a few weeks ago the kind of straight run refinery rate story, which gave naphtha a massive boost, and then also there was talks of there being kind of a supply shortage in Europe, which has been replaced by actually talk of more American C5 natural gasoline, which is what they call naphtha, coming into Europe as well now, which is really just kind of pushing down the naphtha spreads, which brings down the crack. And also just gasoline, there's little length coming there. I think with the petchem margins right now, they are really weak, and we have seen there be a greater demand for naphtha and NGLs in Asia for these petchem margins, but it seems that this also might be kind of overshot as well. And there has been all of this, especially with the LSD FEI being so weak. I think looking at both components of that, the LST is in contango now until 2025, and FEI seems to be at these levels that have kind of become a little overbought, and whether there's actually that fundamental need for the actual physical from these petchem suppliers. I know that polyester margins are really tight. The margins across the whole of the petchem, array aren't that good, and it just seems like there may not be the actual demand to be meeting this supply. So I think that's just a bit of a tangent.
No, it's not a tangent. It's absolutely relevant, and I think that petrochemicals are really important. I think, and propane for our economic debates, because so Asia focused, and we know China are going on about this exporting deflation aspect, and they've invested big time in petchem crackers, right, to be able to produce it. So the question then is, if the margins are tight, can you just say it's going to be bearish because the margins are tight? Now, obviously, you would usually say yes. But the thing is with China is we don't 100% know how their economics work. And one big thing with China is they have refinery margins at least, and I'm sure to some degree petrochemical margins as well, are based on flat price. In other words, they're fixed into their actual market. So they're going to sell at X price. Now with the flat price in Brent selling off so aggressively, if it is a fixed flat price that the government has set, then every time it weakens on Brent, you are getting more money to buy, you're essentially able to buy the feedstock way cheaper and sell it at that fixed price. So if that's the case, which we know is refinery margins as well, and they've got a lead lag here and prices have been higher, it makes a lot of sense that China would come in and buy and ramp up as much as they can, because it's just different economics. And I can't say that for sure, but I know that for the refinery margins point of view at least. Petchems are not as sure, but you see what I mean? And then,
that's really interesting.
Yeah, and it could be like, as you say, but so FEI could be strong because of that, buying down the curve, and the prompt is really pricing really strong. But then you've got to factor in exports at their max, and still people are trying to book cargoes and they can't. So if they're being absorbed, then that's kind of the limit that they'll get from physical. Then there's the CP argument. So they would say import also, okay, you can't buy from US, so you've got to buy from the Saudis. Well, you buy both, but let's say the Saudis is looking more competitive. But if freight prices are going up, they also can't buy that as effectively. So they've got to buy the local Asian, whatever it is in Asia or is pricing to Asia, they've got to buy that priced propane or naphtha in this example as well. So it's just a function of, it's a function of more than just margins. It's going to be an interesting one. But back to your trade, yeah, I agree with what you said about crude. I think it's actually that trade will be quite driven by crude. So if crude does rally, it's kind of what I'm saying. As crude rallies, then if it is the case that Chinese are able to buy simply because of a flat price sell-off, then obviously the inverse should be true from Asia. And if Asia need less, then Europe export less. And if freight gets too high, they can't export either. So there are a few reasons why that this trade makes sense. But I think we have to be clear when we trade a crack, this is naphtha outright prices versus Brent outright prices. And that isn't actually the best expression of a fundamental trade. If you're bullish naphtha or bearish naphtha physical, the time spread's a better trade. But as you said, that's also looking weak. There's a lot of selling there.
Loads of selling.
So that will obviously impact the crack. But then the crack will be a function of Brent as well, is what I'm saying. Mm-hmm. So thoughts? Is a kind of a trending trade now because it's on its way down.
It's we looked at it yesterday when I was looking a bit at naphtha, and the spreads have just been like absolutely annihilated. And I think that we're seeing really healthy selling in the spreads that it doesn't seem to be waning, the selling. So I think we can continue to see that. And then also outright selling in the cracks as well has started to come in a little bit more. We've seen some length being trimmed as well in the cracks outright down the curve.
So people trimming positions, but just overall, like the market kind of balanced still, or more towards the short side?
Yeah, we've seen loads and loads of positions being opened, open interest being shot up recently coming into May especially, and more short positions being opened by far.
Yeah, I mean, looking at that, I mean, for sure the last 7 days, you can see it's very weighted to the sell side. So I can see what you mean. The momentum's coming in. But actually, overall, it's quite balanced still, the positioning. So it's got quite a long way to go.
Yeah, doesn't really seem signs of saturation yet. But I think it'd be important to look at the individual data for the spreads as well before saying that. Okay.
So last week we did a poll on where's the best return right now. And most people said gold, just 36%. 30% said NVIDIA. 21% said copper, and 13% US dollar. That was an interesting one. We'll sign off there, and that was I think things are getting very interesting again. And what we've done is we've made available our research report that we do monthly, as well as other things, but just the monthly report we've made freely available for listeners out there to have a look at. We go into just like forecast, thoughts on things, outlooks, but also our positioning data and what the desks themselves, our trading desks, are thinking of every market. So it's quite a hefty report, about 36 pages. Love your feedback. Love you guys to have a look. One time only, free. It's not going to be forever. And thank you for listening as always. And we'll see you again soon.